Hello, hi. Yeah, today I just wanted to share with you a bit about Cathy Woods. About as I said, this is a three-part video. This is a third part on justifying that Russell stocks, the small and medium cap stocks, will have very little downside risk left, and a lot more upside risk. And I know the consensus in all the headline news is to go for oil or value stocks or the FANG stocks as safe havens. This is a very contrarian view, which I kind of agree, whereby I would still think that the FANG stocks would have great potential because they do not have they are cash rich and don't have much debts. And the Russell stocks, the small and medium caps, in 2020 they have actually raised a lot of funds in the public market. You can see most of the P&L, they have a lot of cash in their balance sheet. In the Russell rally that happened last year. So, okay, I just want to bring you through a bit about what are the views here. So, yeah, 1 second.
Perform. On the contrary, Cathy actually believes that only big tech will be hit substantially by increasing interest rates. This is because she believes that smaller innovative companies can outgrow an increase in interest rates. Chamath Palihapitiya, the CEO of Social Capital, actually mentioned this once as well. He stated that he believes hypergrowth companies would outgrow a marginal increase in interest rates and therefore continue to thrive. That type of outperformance makes sense in relation to big tech. If a company is growing at 50% per year, then a 2% increase in interest rates would lower valuations and reduce the power of compound interest, but it wouldn't be that impactful to the company's long-term success. On the other hand, if a company is growing at 15% per year, a 2% increase in interest rates would hurt that company significantly. A company growing at 50% per year over 10 years, discounted at 10% per year, would grow its revenue by over 28 times. When discounted at 15%, the company's revenue would only grow by 20 times. That's a considerable difference, but it's nothing compared to the impact that a company growing at 15% per year would have. A simple hack to calculating how long it takes for a number to double is to use the rule of 72. The rule of 72 states that 72 divided by a growth rate is equal to the number of years it takes for a number to double. If a company that's growing its revenue at 15% per year is discounted by 10%, then the company would be growing by 5% per year. Therefore,
So you just take a look at this. These are actually, if they look at the 5%, 10% growth per year stocks, they are actually referring to the value stocks, whereby they are still holding on quite well right now.
can take 72 divided by 5 and get 14.4 years. 14.4 years is the amount of time it takes for the company's revenue to double when discounted by 10%. On the other hand, if a company growing its revenue at 15% per year is discounted by 12%, then the company would be growing at 3% per year, which means that the company would take 24 years for its revenue to double. The extra 9.6 years to double is awful for investors, which demonstrates the disproportionate impacts that increasing interest rates would have on larger tech companies. Cathy believes she found a signal pointing towards this outcome. There has been a divergence with the valuations of public and private companies. While the public market has been correcting in valuations, private market valuations have increased. This could be because private investors know that increasing interest rates won't have that significant of an impact on valuations.
Now, I have spoken to some really good value investors, who've been doing this all their lives, and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be hit? And the answer that I found most interesting, and that I think we've just seen in Facebook, is it would be the more mature growth companies that are facing some competition, and not the super growth companies that are just entering into their exponential growth trajectories.
So when she meant by the super growth companies, she actually referring to the small cap stocks. Of course, we need to select a good top 20, 30, with good cash balance in their stocks, and small medium cap below 1 billion market cap, and a good 30 to 40% annual growth that really exceed the increase in the interest rates, outweighs the growth in the interest rates, and yeah.
So again, another argument for new growth. Think Amazon early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%, say 20, 25%, which is what happened. Nobody believed it was possible. Then given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal. We are in that same place with truly emerging growth right now. And the private markets know it, because private market valuations have only gone up over the last year. A paper gathering the data on this right now, but in the last year, as true disruptive innovation strategies depreciated 50% or more, private market, which is which focuses on disruptive innovation, private market valuations seems to have doubled. There's really something wrong with that picture. And I think the private markets have it more right. There's more innovation taking place today than there ever has been in history.
Many retail investors invested in.
So if you see of course, you may not agree with the choices of the ARK ETF, their choices of stocks. I may like certain stocks like Lemonade, or which may not be inside the ARK ETF. There are 5 ARK ETF funds here. So just to share with you a few other details which are quite interesting.
Economists believe that a 25 basis point rate hike or a 0.25% increase will occur in March, but some actually think that a further rate hike will occur. Traders are currently pricing in a 30% chance for a 50 basis point rate hike or a 0.5% rate increase. This is because the latest job report came in much higher than expected. Economists expected 150,000 new jobs in January 2022, but the US ended up adding 467,000 jobs instead. That is a substantial difference and is signaling that the economy is strong right now. The unemployment rate has also remained quite low at 4%. Fed Chair Jerome Powell recently explained how he believes there's a lot of leeway to raise rates while the economy remains robust. All of the economists and institutions are now attempting to one-up each other into predicting higher and higher rate hikes. Bank of America recently stated that it sees 7 rate hikes coming in 2022. One rate hike is typically 25 basis points or 0.25%. So 725.
Yeah, so all this is talking about the rate hikes and whether it has been priced in. And if you base on Cathy Wood's assumption, it's already priced in. The recession is here. So I'll just show you a few other interesting chats.
In the equity market recently is fear, I think, that the Fed is going to go too far, too fast, because is that strategists out in our world are now trying to leapfrog each other, saying, okay, I think it's at least 3 more tightenings after that, or 4. I've even heard altogether 7. So the reaction you've seen in the equity market recently is fear, I think, that the Fed is going to go too far, too fast, because as I will go through in a minute, the economy is quite weak. And I think the Fed could overdo it quite quickly.
If Cathy is right about the Fed not having to raise rates as much as people think, then ARK will experience a serious valuation readjustment on the upside. If the Fed raises rates by 50 basis points in March, that would be an incredible opportunity to purchase innovative stocks. This is because the future outlook would be positive for ARK Invest, as future rate increases may not be necessary. Going back to the previous dot-com analogy that Cathy mentioned, value stocks have continued to increase month after month. Even after the latest sell-off, Ford stock is still trading at a 5-year high. Financials and energy stocks have also been rallying over the past year. The Vanguard Financials Index Fund is up 28% in the past year, and the Vanguard Energy Fund is up.
Yeah, so if you look at it right now, the value stocks are still all at all-time high. The fear actually has created an effect to the Russell stocks and the Nasdaq stocks. You can see major correction there. But if you look at Ford counters and all that, it's still pretty at all-time high. So if any correction happens, more correction happens, it will be based on the value stocks. So I just wanted to share with you a bit about the this part.
Skeptics are completely missing the mark. Our current situation is similar to the dot-com bubble, but the roles are completely reversed. Internet stocks soared during the dot-com bubble, whereas value stocks crashed substantially in comparison. After the dot-com bubble, value stocks rallied in relation to growth stocks. The graph shown on the screen compares the returns of the Nasdaq with Berkshire Hathaway from 1999 to 2004. The Nasdaq crashed substantially, while Berkshire steadily increased in value. Cathy Wood believes we're in a similar situation, but the roles are reversed. She sees 2022's innovative stocks as the value stocks during the dot-com bubble, and 2022's value stocks as the internet stocks in 1999. That might sound crazy, but the performance spread between the two funds is actually quite similar. Over the past year, ARKK is down roughly.
So, okay, on this part, this is the inverse relationship between Nasdaq, Russell stocks, and the value stocks. So, of course, now Nasdaq stock is all-time low, and then the value stocks like the bank stocks and the oil commodity stocks are all-time high. So the inverse relationship may be happening soon. So if you talk about buying those small medium cap Nasdaq hyper growth stocks, is it time? Yes, and not financial advice, but yeah, it is. So what else I need to share with you a bit about quick one about this.
Innovation is in America is ridiculous, I think. But here's what I do know.
I agree with that on a long-term basis. Yeah, it's a dumb idea on the long term. But what I will say on the short term, I mean, they're usually just doing it because they understand the market's extremely rough right now, and they felt like a lot of these stocks were obviously significantly overvalued. Maybe they've taken it too far now. It's dangerous. This ETF's down well over 50%. Yeah, I think it's really dangerous now. I'll put it like that. But if stocks get way overvalued at a particular time, I understand why they want to do it.
When I see, and this is investor psychology, when I see people so sure that we are wrong, and that they are willing to set up companies simply to short innovation, and to set up funds to short innovation, that investor psychology, the pendulum, has swung so far in one direction that if we're right, then the rewards are going to be enormous.
So if you see, the market consensus has been pretty much against. I mean, I think it's wrong to just say that we are shorting Cathy Wood's stocks only. But generally, if you look at Dropbox, Spotify, there are so many other companies that are not inside Cathy Wood's portfolio, but they are Nasdaq, medium cap, small cap stocks. As you can see, the psychology of stocks are very important. Psychology of the market, where the greatest fear when it happens on Nasdaq, and Russell in particular, probably looks like the best time to go in. It's just that now Russell is still at 2000. Before the crisis, it was at around, if I'm not mistaken, was 7,000 plus 8,000. So it has gone up, but there's still a 20% upside base compared to the Russell before the March 2020 period. But then if you look at the cash that was raised by all those companies during the Russell rally and Nasdaq rally that happened in 2020 and 2021, then you probably justify. So yeah, so that's all I have to say today. So you do your own analysis. If you have any comments below, please share with us, and do like the video. Thank you very much. Have a good day and good luck this coming week.